Is it all over? We're going to be smooth sailing and everyone can just be done.
Would we be so lucky? I think there's a pattern here, which is that we see a ratcheting up of rhetoric, measures announced, that then the administration typically rows back. We saw that with steel, big exemptions for the major producers, things settle down a bit. We saw the same thing with China. I suspect we're in a pattern now where we see rhetoric being quite fiery, and actually, so far the actions have been pretty limited.
So the lesson is to not get too worked up over the initial announcement and sort of watch the back channel play out to see what the ultimate form of the tariff or the trade action
precisely. So wait to see what the ultimate form of the tariff action or whatever it might be from the US is. Yeah. Also wait to see what the retaliation from the trading partner might be, because so far that's been very limited.
Yet, you say this is a pattern. The fear is that President Trump could change it up once again, that he might actually levy something and go with it all the way rather than use that as a negotiating stance. I mean, so countries are going to be tempted to respond to each step along the way. Certainly investors have kind of done that initially.
Yeah, exactly. I think the market's starting to learn. So if you look at the market reaction, at least over the past couple of days, EM currencies, which you would expect to be hit hard over all these kind of protectionist concerns, actually, it's been the dollar that's been weak and the EM currencies have been pretty strong. So I think the market's starting to learn to look through the rhetoric, start to focus instead on the actual meat of the measures.
If that's the case, why did investors in the U.S. sell down stocks so much? I mean, the reaction was stronger here in the U.S.
That's certainly the case. I mean, and in fact, equity markets in emerging markets sold off too, but it was the currencies that we saw strengthen. I think there's several potential explanations, but I think one that we need to think about is whether or not investors are starting to get a bit more nervous about the potential kind of policy shifts in the US in terms of it used to be the case that, quote unquote, the adults were in charge in the White House. Now we start to see the economic nationalists perhaps in the ascendancy, and perhaps that's hitting US assets.
Even if, in theory, the pattern is for dramatic rhetoric and then scale down, A, is it possible that something could go off the rails if you get that sort of back and forth tit-for-tat reaction? And B, in the event that, say, with China, we were to see a real escalation, who really gets hit the hardest here in the EM universe that you're looking at?
Yes, I mean, on the first question, absolutely, of course, it's, we're dealing with a situation that's incredibly unpredictable actors on both sides. Of course, it's conceivable that this whole thing could ratchet up unexpectedly. I think the other thing is, as well, from an economic standpoint, it's not just the macro impact we need to think about. It might be the case that some of these measures have no impact whatsoever on the macro economy, but they hit a particular chip manufacturer that's a big component of, say, the Korean equity market that brings down Korean stocks. So we need to disaggregate, if you like, the economic effects and the market effects.
So if I were Tom Keene, I would say, let me rip up the script for a second. We did get news today that Kim Jong-un went to Beijing to meet with some Chinese leaders. And I'm wondering, that is the backdrop to all of this, is the U.S. wants China's help in de-escalating the nuclear tensions with North Korea. What do you read into that, and how significant could that be for markets?
I think that's absolutely critical, isn't it? I think, and that partly explains, I think, why the US has pushed this quite fiery rhetoric. We see the administration pushing fiery rhetoric, but then step back. And the reason it stepped back is because you need China on side when you're dealing with North Korea. I think fundamentally, though, there's simply no chance, and this is perhaps the biggest risk, there's simply no chance I can see that the US deficit with China goes down by 100 billion. There's no chance that's going to happen when the fiscal policy is expanding, the economy's doing quite well. In that situation, I think the deficit goes up, and that's when we start to perhaps see.
All right, let's say we're not really going to get a $100 billion decrease in the trade deficit. What kind of, say, fig leaf measures could you envision China offering Trump that Trump would feel that he can trump it?
Yes, exactly. So I think there's several areas that it could work. One is that market access is clearly a big thing. So we've already started to see the market being opened up to, say, US beef producers. That's something that's taken far too long for China actually to frankly do. And I think so measures market access, measures on intellectual property protection. Again, may not amount to much, but would at least enable a win for Trump to be able to say, look, I pushed hard and this is what I've got in return. Ultimately, though, it doesn't really change much on the ground.
So we've got steel, aluminum, we've got agriculture. What about intellectual property rights? Because ultimately, that's what this is over.
Yeah, and that's a far more thorny issue. It's much more difficult to pin down. Obviously, if you've got a particular concern over trade and market access in a particular good, you can just apply a tariff, impose quotas. IP far more difficult to deal with, and actually that's the nub of the issue. Digital services, trade has become far more sophisticated. Supply chains are developing and evolving, so it's not just about tariffs and quotas and goods. We need to think about services, intellectual property, and the whole gamut.
You mentioned earlier that we should watch very specific stocks or companies rather than just thinking about the micro. Where else, like what industries, what countries would you have your eyes on to really gauge the market reaction?
So I think that obviously China is the big one here, but then you need to think about the economies that are plugged into the supply chains in China.
Right.
So the Koreas, the Taiwans, Vietnam, albeit the equity market there is obviously much smaller and firms less likely to be listed. But it's really China's become this manufacturing hub with the spokes going out all over East Asia. So that's where the pain will be felt.